moderating the panel session today. It is important to say that though it's a great compliment to FMDQ to have such distinguished personalities as our panelists, I'm honored to introduce Dr. Professor Bolahan Elias. He's a senior advocate of Nigeria and the principal partner at Elias & Co. Our second panelist is a seasoned technocrat, Mr. Wale Shonibare. He's a director, Energy Financial Solutions, Policy and Regulations at the African Development Bank. So he's dialing in today from Dubai. I'm also pleased to introduce Mr. Daniel Muller. He's a head origination and structuring at InfoCredit. The next speaker is one I particularly enjoy listening to. He always leaves a webinar session with a nice word of wisdom. He is Engineer Chidi K.C. Izuwa Sr. He is a Director General of the Infrastructure Concession Regulatory Commission, the ICRC. I'm also pleased to introduce Dr. Farouk Aminu. He's the Head Investment Supervision Department at the National Pension Commission. It is a privilege to introduce Mr. Haresh Aswani. He's the Managing Director for Nigeria for Toleram Group. Mr. Aswani is currently serving his 5th term as the Singapore's Honorary Consul General to Nigeria. Our final speaker for the panel session is Mr. Taiwo Adeniji. He's a Senior Director, Investments at Africa Finance Corporation. To wrap up the session today, we have Ms. Kodi Ugoji. She's the Chief Operating Officer of FMDQ Group, and she'll be giving the vote of thanks and the closing remarks on the vote of thanks. With that, I ask for your full attention as we listen to our host, the Chief Executive Officer, Mr. Bola Onadele Koko, please.
Thank you, Adaze, for the warm introductions. The title I have, which I'm going to speak to, is Leveraging the Debt Capital Markets for Infrastructure Development. So I think it's specific to debt. Good morning, ladies and gentlemen. Welcome to this webinar session targeted at the infrastructure sector and organized by the Debt Capital Markets Development Project 2025. Specifically, the Infrastructure Finance Subcommittee of that project. And the webinar is themed Leveraging the Debt Capital Markets for Infrastructure Development. Our objective this session is to create a platform for expert discussions on infrastructure development in Nigeria, i.e. utilizing the Nigerian debt capital market. The forum is targeted at firms in construction, mines and steel, oil and gas, health, transportation, education, information technology, amongst others, and is geared towards critically discussing how domestic and foreign infrastructure financing can be raised through different financing models to create an enabling environment for private investments in infrastructure. To give a brief overview, the DCMD project was set up in 2015 following a workshop organized by FMDQ in collaboration with the International Finance Corporation, IFC, with the support of the Securities and Exchange Commission amongst other key market stakeholders. Its purpose was to stimulate and position the Nigerian debt capital market to step up to its developmental role in the economy by seeking to address the financing challenges faced by various segments of the market. To achieve the Nigerian debt capital market's aspiration to become a world-class, properly functioning debt capital market by 2025, a transformation framework was developed with key broad strategic objectives. These objectives are: 1, improvement of operational efficiencies and time to market for the issuance of debt securities. 2, promotion of market depth measured by debt to GDP ratio. mostly. 3, promotion of an enabling environment to allow the capital market to reach its potential. And 4, diversification of products and investors. Currently, FMDQ serves as a project office, working closely with these stakeholders through the committees and the subcommittees to drive the process of review and implementation of the initiatives required to transform the Nigerian debt capital market within the 10-year project implementation horizon of 2015 to 2025. Infrastructure development is critical for economic growth, reduced poverty, job creation, as well as improving the well-being of the citizenry, and the debt capital market provides a key avenue through which infrastructural growth can be fostered to promote economic development. The McKinsey Global Institute estimates that $3.3 trillion must be spent annually through 2030 to address Africa's huge infrastructure gap. Also, according to the IFC, bridging that gap in emerging markets economies is estimated at $1.3 trillion per year. This is vital to attaining the United Nations Sustainable Development Goals. Infrastructure development is a key driver for progress across the continent and a critical enabler for productivity and sustainable economic growth. Traditionally, infrastructure investments have been financed with public funds by governments, by being the key players given the inherent public good nature of infrastructure. However, given the reduction in the level of public funds available for infrastructure as a result of budgetary pressures, increased public debt to GDP, or in the case of Nigeria, more appropriately, public debt to revenue, and the inability of the public sector to deliver a more efficient investment spending with the presence of competing priorities, it is therefore imperative to recognize that alternative sources of financing are required to support infrastructure development. While government continues to communicate its commitment to investing more in countries' infrastructure, it is apparent that the private sector needs to play a major role in ensuring that the necessary capital is channeled into this extremely vital area, which should drive the much needed growth and development. With access to financing ranked as a top challenge in infrastructure development, according to PricewaterhouseCoopers survey, private sector financing is critical, and the capital market needs to be harnessed to raise alternate finance to be developed to diverse projects through issuance of long-term securities. The existence of an enabling political and regulatory environment is also important in attracting both local and foreign investors into the infrastructure sphere. For foreign investors, we know that the foreign exchange market is important. The federal government in this manner has been supportive in creating an enabling environment for infrastructure development through different initiatives, including the establishment of Infrastructure Credit Guarantee Company Limited, InfraCredit, by the Nigerian Sovereign Investment Authority, NSIA, and Garanco in 2017. It's also helped to develop guarantees to enhance the credit quality of local currency debt securities, both corporate and infrastructure bonds. The government has also actively encouraged public-private partnerships, PPP, which are effective ways of transferring life cycle cost of infrastructure off public sector budgets and simultaneously creating investable assets for the private sector. The signing of the executive order on road infrastructure development and refurbishment investment tax credit scheme by the president in 2019 was also another effort by the federal government. The announcement by the Federal Ministry of Works and Housing through the Highway Development Management Initiative to concession 10 federal highways was also recorded. The latest one is the recent approval of the establishment of the 15 trillion Infraco PLC by the Central Bank of Nigeria. The good nature of that announcement is that Infraco PLC will be managed by an independent infrastructure fund manager. These are some of the landmark initiatives to encourage private participation in the development of our infrastructure. Through the Debt Management Office, the federal government has also issued Sukuk securities worth 350 billion naira towards the construction and rehabilitation of roads across geopolitical zones in the country. And at the subnational level, the Osun state government issued a 10 billion Sukuk security to finance construction of schools. Also, the private sector has witnessed the issuances of infrastructure securities, including the establishment of the Pioneer Infrastructure Debt Fund, the Nigeria Infrastructure Debt Fund by Chapel Hill Denham in 2017. A closed-end fund, I think it's a closed-end fund, and this was focused, sorry, I'll take that again. The private sector has witnessed the issuances of infrastructure securities, including the establishment of the Pioneer Infrastructure Debt Fund, the Nigeria Infrastructure Debt Fund by Chapel Hill Denham in 2017, a closed-end fund and focused on traditional infrastructure sectors, Vitan Funding PLC 10 billion bond in 2017 to finance the construction of new plants and gas-fired generating equipment, and the issuance of the 8.5 billion 15-year green infrastructure bond by North-South Power Limited in 2019, guaranteed by InfraCredit. Here at FMDQ, we recognize the increasing role of the inclusion of private capital in the Nigerian capital market, which had hitherto been serviced only by public companies. At the beginning of this year, FMDQ Private Markets Limited was incorporated to enable private companies, irrespective of size, access the markets for funding and raise vital capital to expand operations and function as efficiently as possible within their various sectors. We must look to both publicly listed and private capital as possibilities in developing infrastructure in Nigeria. I am pleased that discussions at this session will span across government incentives and regulatory reforms to unlock infrastructure development, the scope of de-risking tools in making infrastructure projects more attractive to local and foreign investors, the national policies on PPPs, which highlights diverse PPP implementation models that are available, encouraging capital towards environmentally friendly infrastructure, driving investment of pension funds to infrastructure securities, as well as success stories of infrastructure financing in Nigeria and overcoming post challenges. My appreciation goes to the DCMD Project Steering Committee Chairman, Mr. Bolaji Balogun, and also the Infrastructure Finance Subcommittee, co-chaired by Dr. Wura Biola and Mr. Ayogbilei, for executing this session, and I look forward to ensuring that FMDQ plays its strategic role as the secretariat of the DCMD project to take key resolutions on board and partner with stakeholders to drive implementation. Once again, I welcome you to the session and restate our mandate to develop the Nigerian infrastructure sector through leveraging the debt capital markets and by collaborating with various stakeholders in sensitizing, advocating, and engaging with key market players. We hope to be able to diversify the bouquet of debt capital markets products to facilitate the efficient raising of capital for projects in Nigeria. Thank you, and I wish you fruitful deliberations.
Thank you very much, Mr. Onadele. Thank you for that powerful opening remarks and the overview of the debt capital market development project, and also where we are with infrastructure finance and development in Nigeria so far. Thank you so much. Now I wish to introduce Mr. Balogun to give his presentation and set the context for this webinar. Mr. Balogun, please.
Thank you very much, Adaze. And Coco, let me, firstly thank you for the incredible work that you and your colleagues at FMDQ, continue to do. around deepening Nigeria's debt capital markets. I think it's absolutely clear, that if any country is going to develop, that country develops, primarily around the base of deep, liquid, domestic debt capital markets. And therefore, the role that you play in that respect is really, really pivotal. Welcome, all panelists, and really delighted to share this platform with all of you. I'm a father of twins, so I never do anything alone. And my presentation this morning is going to be shared, between my twin, and I. And if the journey that we've run on infrastructure over the last 7 years, I've lived every day of it, on planes, in cars, with Phil Southwell, who's my partner at the firm. And he and I will take you through the presentation. With the permission of our hosts, I'm just about to share some slides, and the whole idea is that we try and keep this, quite brief, and the slides are visible as much as possible. I'll try to set a context, by providing, some kind of background. And I think it's really important, firstly, when we think of infrastructure, that we don't think about infrastructure as one asset class. Within our firm, and I think this is a view that's shared by many other thought leaders around infrastructure, there are essentially 3 asset classes within infrastructure. There's first and foremost development and construction equity. And by and large, that is not a product that is fit for debt capital markets. But there's infrastructure debt and there's operating infrastructure equity. And both of those asset classes are fit for capital markets. But the one that's really important to us, and the one that to a large extent, tends to be there for the bulk of the life cycle of an infrastructure asset, is infrastructure debt. And to the largest extent, this is the biggest, share of the pie. This typically will be somewhere between 70 to as much as 90% of the financing on every infrastructure, transaction. And this is why it is so fundamentally important. We believe that infrastructure is very much the cornerstone to growth. And if you look at Nigeria and you think about the myriad of issues that Nigeria has as a country, I think we begin to address them when we begin to focus on a platform of specific infrastructure investments. We believe, and this circle, we call it, a circle of prosperity, is something which we've trademarked at the firm. Basically says to you that if you invest in power, you invest in energy, you invest in transportation and broadband networks in Nigeria, what you are going to do is to create the foundation for catalyzing a series of investments into agriculture, into mining, into SMEs, into manufacturing. But beyond that, you will also bring significant investments into social infrastructure areas like education, like healthcare, like security and retail. But most importantly, you also provide the platform for dealing with our significant housing gap. Again, because it sits, on a foundation of infrastructure. And when you start getting investments into all of those sectors, what do? You create jobs. And if you live in a country where today there are 200 million of us, they tell us that in less than 30 years, there could be 500 million of us. And most recently, there's been a very exciting study done that says that by the year 2079, Nigeria would be the second most populous nation on earth. And it is not impossible that by the year 2100, you could have 1 billion Nigerians. Now, what does that mean for all of our people thinking about infrastructure in Nigeria? It means that when you're thinking about building a road, we cannot be building 2- and 3-lane road highways. We should be thinking about building 6- and 10-lane highways. Because even if that demand is not there today, over the life cycle of that asset, which is going to be 30 or 35 years, that demand is going to come, and it's going to come very, very substantially. But we also need to think about our carbon footprint as we think about financing infrastructure. And this is really, really important because to a large extent, while 70% of the world's infrastructure needs is in emerging markets, and Nigeria is probably the last really exciting infrastructure opportunity across the world, 70% of greenhouse gas emissions, also come from infrastructure. So as you build out infrastructure, it's really, really important that we think about our carbon footprint. And it's all about ensuring that we focus on building low carbon resilient infrastructure. And in many senses, again, the work that debt capital markets do around sustainable finance is really, really critical. And sustainable finance in many respects is absolutely accretive to all of the 17 SDGs. I'm going to share with you the reality of Nigeria's situation. And the reality of Nigeria's situation, and I focus on the federal budget, for these purposes, is that at any time over the last decade, there has never been a point where the federal budget has provided for more than about 20% in capital expenditure. But when you zero in further into that provision for capital expenditure, what you're going to discover is that actually only about 7.5% of it is what is going into critical infrastructure. The bulk of what else is described as capital expenditure includes things like cars, computers, and so on, that are bought, across, the federal, government as a whole. Now, when you think about the government's budget, this year's budget, which is our largest ever budget, essentially is broadly a $26 billion budget. If 7.5% is all that is going into critical infrastructure, that suggests that the number is somewhere around $2 billion annually at federal level that is going into infrastructure. When you think about Nigeria's annual need today, just to catch up on infrastructure, you're talking about $35 to $40 billion on an annual basis. And what that says to you is that the government wallet, no matter how you flex it and stretch it and lever it, is completely inadequate. And there is no magic that you're going to do to the government's tax base in the short term or to its sources of revenue in the short term that are going to change that. So Nigeria, like every other part of the world, is going to have to wake up to the reality that it's all about private capital. And without private capital, you cannot really get infrastructure spending increasing at the level that it then has a multiplier effect that is quite substantial on economic growth. If you're able to increase infrastructure spending 15 to 18% annually, what you will deliver is an economy growing at 8 to 10% on an annual basis. And that's what an engine of this size, if I might describe Nigeria PLC, a big engine, that's what it needs to be firing properly. Let's talk about the opportunity, because the opportunity is a really exciting one. And I quote from no less an authority than the African Development Bank, and I'm really delighted, to have my brother Wale Shonibare, on this panel with us today, because they do some really exceptional work around African infrastructure. And they estimate that the annual need for infrastructure across sub-Saharan Africa is $93 billion. And today, less than half of that is currently invested. But on a global basis, what is most exciting is that the areas that need the most infrastructure investing the bulk of those countries are in Africa. And the evident one and the largest one by far is Nigeria. So when you think about Nigeria, Nigeria represents an incredible opportunity, not only around physical and economic infrastructure, but also around social infrastructure. And if there's one lesson that the recent COVID-19 crisis that we're all living through has taught each and every one of us, it is that areas like healthcare that you and I always thought of as social infrastructure actually have very significant economic implications. And whether we like it or not, we need to, begin to shift that paradigm and the way that we thought of infrastructure. Nigeria has a big problem. And what is that big problem? When you put together all of the efforts and all of the dollars that are going into infrastructure in Nigeria today, we are literally only scraping the surface. And a lot of that is happening outside of public markets. So we're going to have to wake up to a reality that the rest of the world has figured out, that there's only so much, that DFIs and all sorts of other initiatives can do on their own. You are going to have to do this thing through utilizing capital markets and specifically through debt capital markets. And let me try and provide, a perspective that really tells, this story quite well. When you look at the scale, right, of ODA, or what I'll describe as overseas development assistance, and this really is an aggregation of what all of the, global DFIs, are doing, in terms of investing globally, right? What you're going to find is that that total number is somewhere less than $1 trillion. Today, in institutional capital, in other words, in institutional fund managers globally, there is $140 trillion of capital. And in listed infrastructure today, right, there is an increasing commitment to institutional capital. So what is the message saying to you? The message is saying that to date, we have done so well, just sort of focusing, on banking sources historically, DFIs, but all of those balance sheets, large as they are actually relatively insignificant, right? Combined, as compared to global institutional capital. And the challenge for all of us in all capital markets, particularly in a market like Nigeria, is how do we create that alignment where we get DFIs who know infrastructure as an asset class and have a lot of history doing it, and we combine them with institutional capital, and that is when we're really going to unlock really big pools of capital for financing infrastructure. So it's not about the traditional paradigms that we've used to finance it, and the results are pretty evident to you and I, and we don't need to talk about it. Just thinking about how long it takes you to get from one end of Lagos to the other, in spite of the incredible investments that Lagos continues to make, spending on infrastructure at a higher ratio than the sovereign is doing of its annual budget, it is still somewhat constrained as an example. So it's all about institutional capital, and it's about creating these platforms that institutional capital are comfortable with. And this is really what we're going to focus on in the final few slides here. And if you understand that it's all about institutional capital, then what we need to ask ourselves is not what we think is right, it's actually what is the product that institutional capital will buy. And if you look today across the OECD markets, and Nigeria as a market is just trailing many of these markets, what you will find, which is quite astonishing, basically is that OECD pension funds and institutional capital on average are allocating somewhere around 85% to listed instruments and to cash. So what that means basically is that if it's not listed, they're not interested in it. And if it's listed, it needs to yield. And that's very, very important for pension funds and so on. The second key message that comes across very clearly, and we must pay attention to this, is that it's not about individual project risk. Institutional capital wants portfolio risk. It wants that diversification, right? It wants that broader expansion, okay, to a portfolio of infrastructure assets and not one. The third and most critical element is that there are certain investment themes, and all of those investment themes are very relevant and important to Nigeria. And institutional capital is very focused on ESG. Institutional capital is very focused on green investments and also very keen on Sharia or non-interest finance instruments. So therefore, in thinking about how do you capture this big opportunity out there? And I say this big opportunity because the problem for infrastructure is not money. The real problem, right, is understanding how we create a bridge between Nigeria's problems and attracting institutional capital to solve many of those problems. And what is pretty clear is that private capital will be pivotal in infrastructure financing, and markets will be critical. And it's markets through bonds and funds because they represent a sustainable funding source. I'm now going to ask Phil to take us through the final slides. Thank you very, very much.
Thanks, Balaji. Just as a segue, to what Balaji was saying around the importance of diversification, the next slide looks at this bridge. And this bridge is looking at the types of investors who are focused on single projects. So corporates and project sponsors, obviously are focused on building single project assets. DFIs, tend to be focused on building new greenfield projects. And obviously governments, by and large, tend to work on single asset PPPs. So you have this single project focus from many important institutions. But as Balaji said, what you have in the institutional market is this desire for a diversified portfolio. I've not really met many institutional investors who have the ability to analyze a bridge versus a road versus a power plant across 54 different countries across the African continent. And so I think for that reason, it's incumbent on us to create those diversified portfolios. And that really is the role that FMDQ and capital markets can play in terms of creating those portfolios for the institutional and public markets. In order to access those public markets, we think it's important to corporatize infrastructure. One can structure portfolios in private form with GPLP type structures. One can also structure these in corporates and investment companies and so forth. I'm sure there are lots of pros for and against different structures, but money talks. And when you see $2.7 trillion in listed infrastructure and more than $1.5 trillion in REITs, I think it's important to understand what those institutional investors seek globally, and then apply that knowledge base in Nigeria. I don't think we need to come up with a Nigerian solution here. We can just learn from those messages internationally. And so I think it's incumbent on us to find these corporate structures and to apply those and list those on the public markets. One additional plus of a corporate structure is that we all understand what they look like. We all understand what the financial reporting requirements are. We understand what the governance structure is. We understand, that boards are there to protect minorities, to disclose related party transactions. That there is a governance structure around a corporation, which is very, very well understood. Second point on this page is around project finance tenor. Project finance tenor has always been important. If you're building this very large infrastructure asset, you need to have long-dated finance to support that. If you have short-dated finance, you're then creating refinancing risk, and you're creating financing risk in the project. By and large, prior to the global financial crisis, banks were able to do this. But the regulations around banks have changed that thinking. And they've changed that thinking not because the credit risk around project finance has changed, but because the capital requirements for making long-dated loans against a short-dated deposit base means that banks need to have much more capital today for these long-dated loans than they needed to 15 years ago. So capital markets can provide a solution. Your capital markets don't need to calculate risk-weighted assets. Capital markets can look at the credit quality and the yield that is generated from those infrastructure assets. And if that yield is providing the sort of premium that the market likes, it can then buy. So we do think that's an important element. And then final thing on this slide is that a corporate is naturally able to create a portfolio. And so a corporate can have a number of different activities in a number of different PPPs and projects. And it can raise project finance at the project level. It can raise corporate finance at the corporate level, using capital markets like FMDQ. Third part of packaging is around currency. The chart on the right-hand side of this slide, I think, is familiar to everyone. We know what the FX rate is for a Naira dollar. We know what the FX rate should be. So you can sort of calculate what the devaluation should be for Nigeria by comparing Nigeria's inflation rate and deducting the US inflation. So one can do work to discover what you think should be the annual devaluation. And we can look obviously at past experience. What we know is that every G20 country finances its infrastructure in its own currency. The solution for Nigeria is not to replicate a zero power 200 times, because doing that is going to create an FX burden that the sovereigns simply cannot withstand. And so we need to find local currency solutions. We know that's how the G20 finance, and we know that's how other emerging markets, in the African context, Egypt's a good example, are progressing. Just to wrap up this section from Balaji and myself, with Africa Development Banks, with NSIAs, and most importantly, with the PFAs regulated by PENCOM, we have been able to develop a portfolio of project finance loans in Nigeria. Over the course of 3 years, we have been able to create a portfolio across 9 broad subsectors. And we're very pleased that 23 of the pension funds in Nigeria have invested. There are other ways of measuring success. And the one I'll highlight on this page is that over the course of the last 3 years, we have been able to reduce CO2 emissions by just over 1.2 million tons. So I think that also is an important metric. But on the slide that I'll leave you with, from a institutional perspective, arguably the most important thing is the returns, and the total return generated is 78% in Naira. And that really is the reason, why this is a success with the institutional market, and why we should find ways of replicating this across the Nigerian market as a whole. Thank you very much. And I'd like to hand it back to the moderator, please.
Thank you. Thank you very much, Mr. Balogun and Mr. Southwell. Thank you for that very insightful presentation. Indeed, we do need institutional capital to drive sustainable infrastructure development. Now we're going to hand over to Dr. Abiola, who will be moderating the panel session. I want to welcome everyone on YouTube and everyone else on this platform. We have over 250 people online and over 300 on YouTube. So we're looking forward to the next session. Dr. Abiola, please.
Good morning, everybody. Adeze, thank you very much. It's really a great pleasure, a huge honor to be on this panel with such eminent, diverse groups of practitioners and experts in the area of infrastructure finance in the emerging markets and Nigeria in particular. On behalf of the Infrastructure Finance Subcommittee, I'm very pleased that we've been able to put this program in place, and thank everybody for supporting the endeavor. Mr. Balogun and Mr. Southwell's presentation has set out the discussion very nicely, I must say. Over the next hour and a bit, we will crisscross across the macro and project-specific issues that need to be addressed to unlock the quantum of debt capital required to propel Nigeria's economic and social infrastructure properly into the 21st century. With over 200 million Nigerians and growing, and a very ambitious desires for economic development, this is an urgent and compelling necessity. This long-standing challenge has become even more complicated with the COVID-induced disruptions to the global financial markets. So this is a very timely discussion, taking into account our traditional issues and recent developments. Before I turn to Professor Elias, let me just remind everybody that there's a poll, and kindly just take a few seconds to respond to that poll. So, Professor Bolamo Elias, let us go very quickly into the panel discussions and start with the macro issues. Would love to hear your views on the adequacy or otherwise of the policy and regulatory environment in Nigeria. Prof, what would you say are the government incentives, the legislative reforms required to unlock infrastructure development in Nigeria? Kindly keep your response to about 3 minutes, if at all possible. Professor Elias?
Try and get him. Sorry, Doctor. We'll probably move to the next speaker, Doctor.
Perhaps we should do exactly that. So after Professor Elias, we were going to go to Mr. Wale Shonibara. I hope you're there. Mr.
Yes, I am.
Excellent. We've had many discussions on this topic, so I look forward to hearing from you, especially given your vast experience in infrastructure finance across the continent. So specifically, what new finance financing approaches would you recommend for infrastructure finance in Nigeria? It would be helpful if you could put into context your answers with some examples from your AFDB portfolio of successful projects, please.
Okay, thank you, Dr. Abiola, and thank you to everybody. It's a great honor to be invited onto this platform. I found the previous presentation very compelling. Of course, I've been following the development of the Nigeria Infrastructure Debt Fund since its very beginning. So I know its history, and I'm very happy and proud to say that you know, through that involvement, AFDB is the first and only DFI that is investing in that fund. And the reason we took the decision to invest in the fund is because we're very keen to encourage financing in local currency, because in the long run, that's the only sustainable option. You know, you don't hear about the United States funding its infrastructure in Japanese yen. And so, you know, when you go to places like South Africa, you fund in Rand, you go to India, you fund in rupees. In the long run, that's what we should be doing. The African Development Bank has 11 approved currencies. We can lend in hard currency, and where possible, we can also lend in local currency. So in countries where you have deep capital markets, then it's appropriate. So we're looking at these options in Nigeria, in Egypt, in Kenya, and other countries where those capital markets are deep enough to allow the kind of innovation that NIDF has been able to achieve. How do we create that bridge between the institutional investors and the infrastructure assets? So creating this vehicle is very welcome. But that's not the only thing, because you know, infrastructure is quite complex. Apart from deep capital markets, we also need to have projects that are well prepared. And you find that that's also a gap, the development capital required to prepare projects in the appropriate way. So the African Development Bank has been able to intervene in that area. We have various trust funds that we use. We have one called the Sustainable Fund for Africa, SEFA. And that one is to help develop renewable energy projects. And there's significant amount of interest in renewable energy. We are also working with the World Bank right now to catalyze the biggest market for off-grid energy in Africa, which is in Nigeria. So we're providing $200 million under the Nigeria Electrification Project, along with the World Bank's $350 million, to be able to leverage about $1 billion into that sector. And those projects are already happening. You're seeing them in the markets. We're working with the Rural Electrification Agency and we're going to be electrifying universities as well as health centers, and also providing rural electrification. Africa's electricity access rate is around 41%, which is not good enough. If we have to get to where we need to get to, we want to get universal access. Out of the close to 800 million people worldwide that do not have access to electricity, 600 million of them are in Africa. And unfortunately, 95 million of those are in Nigeria. So Nigeria is actually the single largest country with the highest number of people without electricity in the world. That is not a statistic that we should be proud of. So the African Development Bank has also been funding other parts of the value chain. So $200 million into transmission assets, and then also looking at how we can help the distribution companies. We, as well as providing money, obviously we'll provide technical assistance. So we have to help markets develop products that will allow you, because debt is not enough, you have to have equity. So we'll be launching the Nigeria Energy Access Fund very, very soon, working with the likes of AFC. I'm glad that Taiwo is here, as well as All On, to look at how we can provide the equity part that goes along with the debt. So perhaps I should just stop here. Happy to expand if you need me to.
Well, that was a very disciplined presentation of your thoughts, because you banged on 3 minutes. Thank you so much. I think Professor Elias is back with us. Professor Elias, can we just hear from you very briefly about your thoughts on that general theme of the macro environment and how enabling it is for infrastructure debt finance for in Nigeria? Thank you.
Yes, thank you very much, Doctor. I also thank the FMDQ for this opportunity to share my current thinking on the issues arising with everyone. I'm a lawyer working in Lagos, and a significant part of my work is in the infrastructure space. I think that there are three very important things that the government still needs to do. One of these is to make sure that there's a coherent regulatory framework in all of the various subsectors of infrastructure. As matters currently stand, there is no coherent regulatory framework, for example, in the rail sector. Even outside the rail sector, there's been to and fro about whether there should be a commercial regulator of the transport sector. That's the regulator of rates within the sector. We now have NERC, which is the regulator for the electric power sector, but clearly there's still a lot of work to do there. But as a broad point, we need a coherent regulatory framework in any sector for the equity to come in the first place, and even after the equity has come in, for the bond investors to come in and to be reasonably confident that they will get the returns that they are expecting to get. So a sector-specific regulatory framework is one factor. Another is the tax regime. Mr. Balogun talked earlier about the new tax incentive that the federal government has given in the road sector, and that's certainly commendable. But there is also an incentive that is needed across sectors, and not just for the road sector. The key one for me is the reduction or a reduction in the price of debt financing. As the law currently stands, there are very heavy stamp duty charges and also very heavy charges for registering security, whether it be at the Corporate Affairs Commission, which is federal, or at the level of the various states where the infrastructure involves land and a charge over land needs to be perfected. The cost of perfecting security is very high. And this is especially discouraging for investors because it's a significant amount of money to be shelled out at a time when the project has no cash flow yet. There are various structures that lawyers have developed to try and address this. And some of them involve only a partial payment of the stamp duty in the beginning. But clearly there are investors who are not comfortable with that, especially foreign investors. And if they can't get full security from the beginning, they're not comfortable. And if they do get full security, it means a great deal of money has to be paid out in the beginning. And it can affect the returns on the project. The third big change that is needed from government is the efficiency of being able to enforce your rights as a debt investor. If things go wrong, how efficiently can you enforce your rights? Are the proverbial and well-known delays in our system, in our court system, not an issue for the investors? They clearly are. It's part of why these days virtually every major contract has a clause for arbitration in the UK. It doesn't run through our system. Our system doesn't get to develop. And even if you get an award in the UK, you still have issues of enforcing that award in Nigeria, as we've seen lately from some things in the press. So these are the three areas that I would like to emphasize. Better sector-specific regulation, or fuller sector-specific regulation, lower taxes, and a more effective machinery for enforcing rights. I think it's important to have all of these three, because without them, the equity doesn't even come in. And if the equity doesn't come in yet, the debt can't come in and you can't have it on market. Thank you.
Professor, thank you so very much for those three clear points. I dare say we may have to come back to some of them during the Q&A session. But for now, let us turn to Daniel Mueller. We would love to hear from Daniel if you're there. Some of your InfraCredit's very specific, unique experience in terms of the available de-risking tools for enhancing the bankability, or dare I say generally the attractiveness of infrastructure projects to investors in the debt capital markets. Daniel?
Thank you, Dr. Abiola, and thank you, FMDQ, and all the other panelists and participants. This is an important event. Again, on some of the de-risking areas, there are four main risk areas that most investors and lenders will look at. One is your market or demand risk. Who are the true purchasers of the services and products that the infrastructure is meant to deliver? The second area is technical risk, which includes project management and operational risk. Any lender wants to make sure the project will be delivered on time, on budget, in accordance with the technical specifications. Political risk is the third area. Infrastructure projects, as Mr. Balogun had said, are naturally long-term, and during the life of an infrastructure project, it's normal for there to be political changes, and any lender wants to make sure that those political changes do not impact the viability of that project. The fourth area is around the sponsor risk or the integrity risk, making sure that it's the project being developed is by a reputable counterparty that the lenders want to back. In terms of de-risking tools, one of the earlier speakers talked about project development, and that's the first area, is your project preparation. Very few lenders want to look at a project that has not started its technical viability studies or its commercial demand studies or its environmental and social impact assessment. These are basics in project preparation that one will expect have started to be addressed before a lender gets involved or a new investor gets involved, because they can take a bit of time to actually conduct. The second area of de-risking, the second tool, is contractual, and there's a lot of sort of legal aspects to the contractual de-risking space. The first is again around your engineering, procurement, and construction contract. That's your EPC contract, making sure that it's turnkey, it's fixed price, and there are liquidated damages for delays backed by performance bonds. A lot of infrastructure projects are not done that way, and then they run into challenges when you have different contractors that cannot do their work because another aspect of the project has not concluded or was not concluded in the manner it was supposed to be done. So having a holistic sort of EPC contractor responsible for the entire project certainly simplifies it from a lender perspective. A second area is around your equipment suppliers. Those are your OEMs, making sure you have warranties for a few years on the key assets, as well as potentially a buyback option for key equipment, if that's feasible. If you're building a road, obviously there's no buyback option, but maybe if you're doing a gas project or a power plant, and the project doesn't go to expectation, having the ability for that supplier to actually buy the equipment back can be helpful. The third area is one of the most important under the contractual tools. This is your offtake agreements, where there are products or services that we purchased from the infrastructure project. Creditors want to see contractual risk as opposed to market risk. They don't want to be guessing in terms of how big the potential market is. They want to know who the counterparties are. Are you selling to Dangote or Lafarge? Are you selling to a state government? Who are you actually selling your services to? If they're, and so trying to have these contracts in place early and having them be long-term in nature, backed by bank guarantees on behalf of the off-takers, this is a key area to reduce the sort of perception around market risk. A fourth contractual area is your supply agreements. Again, you want long-term supply agreements, you want long-term asset agreements, you want long-term local currency financing. All of this matches the long-term life of the infrastructure project being done. in the political space, to the extent that government is involved, and they generally have a role to play in terms of granting the land or a concession, buying some of the offtake. In these cases, you want a direct agreement with the government itself. So the creditors will insist upon having a direct contractual agreement with the government related to some of the commitments on the project. The third area, the third major tool, and this is probably the most interesting to some of the participants, is around credit enhancement. How do you actually structure additional credit enhancement to support your infrastructure project and get access to financing? And the first area there is where you do not have sort of third-party guarantors, is you over-collateralize the project in the beginning. You add additional assets as security to the project in order to get it off the ground, and you can have a pre-agreement for some of these assets to fall away later, that they are not pledged for the long term. Once the infrastructure project is built and meeting some performance conditions, you've pre-agreed for some of those extra assets that gave the creditors comfort in the beginning. Those assets then fall away at a later date. Other credit enhancement may be some minimum revenue assurance, especially from a state government. There may be a parent company guarantee around the debt being procured for the project. And again, around credit enhancement and project structuring, most developers only want to bring in the assets for the project being built. They don't want to go and add other assets. So most developers want to do a project finance structure, whereas most creditors want to do a more corporate finance structure, bringing these other assets and cash flows in to back the project. Another area is third-party guarantees, and that's where my company, InfraCredit, comes in. I had the transaction team, what we call the origination and structuring team at InfraCredit. We've guaranteed 31.5 billion naira worth of corporate infrastructure bonds over the last 2.5 years. There are other guarantors like commercial banks, but they usually cannot go as long of a tenor. You have African Development Bank, Grantco, other international guarantors that can also support projects with that third-party guarantee. And then there are the government guarantees, an irrevocable standing payment order from the state government, backed by its internally generated revenue accounts or backed by its federal allocation, its FAC account from the federal government. You also have federal government guarantees and also international guarantees, like a partial risk guarantee from the World Bank, which is also backed by the federal government. From a fourth sort of de-risking tool is just your general strategic approach. Developers who have a collaborative philosophy generally are going to be able to get their infrastructure project off the ground, as opposed to someone who wants to hold all the components for themselves. And the power sector in Nigeria is a very good example. A lot of smaller, medium-sized power projects cannot get off the ground because people are trying to hold all the customers for themselves. But where a new investor is willing to work with the distribution company, where that collaborative philosophy is deployed, these projects usually have a better chance of succeeding in the long run. Also, part of your strategic approach is your regulatory approach. The sooner you face the regulator, the better. Infrastructure projects are long-term, so you're certainly not going to expect anyone to into a project and take risk if you don't have your regulatory approvals. The third area of your strategic approach is demonstrating a culture of compliance. A lot of the infrastructure financing opportunity in Nigeria is getting access to the assets under management held by the pension funds in Nigeria. And if you are not, as a company, already compliant with your pension obligations, that means you're not going to have access to the debt capital market because the pension funds are not going to invest. So you need to demonstrate very early as a developer that you have a culture of compliance around pensions, around taxes, around insurance, and these areas. Two structuring approaches that people can consider.
Mr. Miller, you're running out of time. Please.
Yeah, I'll hit these last 2 points. So two structuring approaches, thank you, is in some industries, especially healthcare, some of the mini grid and sort of agriculture, is where you don't have contractual offtake. One is that we go with an equipment leasing approach, where there's a central company that owns the assets and leases it out to multiple healthcare facilities or multiple agriculture groups or multiple mini grid operators. Those are the operating companies. The credit would actually back the leasing entity. And a second structure is where you separate the manufacturing side from the distribution side. So a company can actually set up two entities where the manufacturing entity is the one that the creditors back and the guarantors like ourselves, InfraCredit, back. And there's an offtake agreement with a distribution company that has the same sponsor at the end of the day as the manufacturer. But that's a way of creating that offtake agreement and contractual commitment to buy the product that wouldn't necessarily exist in some industries. Thank you, Dr. Abiola.
Thank you so much. I suspect we're going to have to come back to you because I can already see quite a few questions coming up from what you presented. Again, thank you very much. Another set of questions has to do with whether or not presentations will be shared. Rest assured they will be shared, and the Secretariat will give more details at the end as to where you can find those presentations. So from those 4 key types of de-risking tools, it was very instructive that you have included the strategic approach of the project developers. And I think there are some questions around that as well for you later down the line. But for now, let me move to Engineer Chidi, who I know is a big advocate for the creation of viable ecosystems to support infrastructure development. I hope you're there, Engineer Chidi, because I want to ask you specifically, what are the ecosystem requirements that you can see in order to attract finance for infrastructure development in Nigeria? Where are the gaps? And what are the low-hanging fruits to improve on those gaps? Thank you.
Yeah, I mean, Wura, thank you very much. It's infrastructure is such a, an exciting subject for me. So it's very challenging to talk about infrastructure in 3 minutes, but I would try. And I think probably the best way to do is to sort of to pivot and sort of amplify what Bolaji said, because myself and Bolaji, we've been on this for quite some time. But I think the first thing I just want to say is, look, we've got an infrastructure emergency. And I think, whether we like it or not, we must accept it. And fundamentally, COVID, it's basically changed everything. It's changed the national policy, it's reformed the society, whether we like it or not. And we've got a new normal. And I think we must, sort of, plan along that line. There needs to be some desperation on our part to address infrastructure. And I think the person who best put it forward for me is Sunny Bati, Mita. He said, look, beg, steal, borrow. Africa needs to build infrastructure. Nigeria needs to build on infrastructure, because that is very critical for our survival. It's also very, very critical, for the post-COVID world. And I would like to expand the frame that we need to sort of, look at both federal infrastructure, state infrastructure, and local government infrastructure, to build the quality of life that's good for everyone. I mean, imagine Lagos with an efficient public transport system. Or the converse is, imagine London without the underground. And I think that, the mayor of Bogota put it very simply and said, look, a developed country is not a country, where the poor have cars. It's a country where the rich use public transport. And you look at something like, the public health system. Imagine if we had a well-functioning primary healthcare system across our local government areas, how easy it would have been for us to manage, with COVID. And I think that, we need a big bang. And I think that that's the point that comes out from the presentation, Bolaji has made. I mean, we need, we don't need one NIDF, we need tons and tons of NIDF. We need to judge, what we're doing. There's a lot that we have done in infrastructure, but something I think we haven't spoken much about, which I'd like to pay emphasis is, look, we need to draw a difference between financing infrastructure and funding infrastructure. And finance is not the problem. And I think, Bolaji alluded to that. There's private capital, all over the place. The point is it's funding. Financing is the upfront cost for the infrastructure. Funding is how you pay for the infrastructure over the life cycle. I mean, if people are not prepared, and I think this is something we need to sort of interrogate ourselves. If we as Nigerians or Africans are not prepared to pay cost-reflective tariffs, for infrastructure services, the financing will not come. And it's more critical when it's got to do with private finance, because private finance needs to be sure that returns will be made. I mean, the guys who are going to buy these bonds and securities are not Mother Teresa. You know, it's not zakat. You know, it's a commercial transaction where people expect to make decent risk-adjusted returns. And I think we must come to, you know, that fact and have that acceptance, you know, to be able to attract the sort of private capital we look. And we've had successes, and I think we can build on those successes and scale on them. And I think Harish is here. I mean, Lekki Deepwater Port is a big success. We need to talk, more about. And when I look at, you know, what impact those things can happen, I mean, very often I sit back in my room and I'm watching TV pictures of huge materials being moved from Apapa at heavy cost to the Dangote refinery. And I said to myself, if Lekki was there, how easy it would have been just to go across the road, and look at what it would do to the cost of the project. If Lekki as a port was there, I'm sure the cost of building the Dangote refinery will come down by 10 to 15%. So that's a success. What we're going to do with the HDMI, I mean, we need roads across our country to be able to power economy. And I think, you know, John F. Kennedy said it, America is rich. You know, America has good roads, not because America is rich. America is rich because it has good roads. You know, transportation is extremely very critical to build a functional society. So that program of the HDMI, we've got things we're doing with students' hostels, we've got things we're doing with power. So all that is working very well. But just to sort of address some of the issues you've talked about the ecosystem, there are certain systemic challenges we need to address. The first of them is time. You know, if you're looking at public-private partnerships, you know, you need time to prepare bankable projects. You know, you need time to do the feasibility studies, you need time to get the approvals, you need time to get the stakeholders. So I think we need to find a way to accelerate, you know, the timing we need to deliver our projects. Then we look at things like, project development funding. And I think Wale has alluded to that. You know, we need to have, you know, the funding to develop these projects to a state, you know, where they're bankable and the private sector, you know, is interested in, in investing, because the capital you want will come in later, you know, when the project is bankable, you know, goes into the market and does it. Then things like unsolicited proposals, you know, we in the ICRC, we have tried to change that word, you know, because government will not be able, and I think this is very clear, we don't have enough funding to develop every infrastructure project that needs to come. So we need to change our attitude to unsolicited proposals, which is why the ICRC is actually moved away from calling them unsolicited, because they're not unsolicited phone calls. Those are critical infrastructure we need. What we call them are privately initiated infrastructure projects, because that's what it is. You know, the private sector sees an opportunity, and we must not see them as things that are not acceptable for economy. And we can apply, you know, competition to them to be able to develop. And I mean, some of the best projects, if you look at Korea, 70% of the projects that made Korea where it is today were unsolicited. The same thing with Malaysia. So I think for me is that we're spoiled with choice. You know, where we are, you know, there are different examples, you know, across the world. And what we need to do is to copy shamelessly. We copy, mix, and paste. And that's innovation, because there are models. I mean, we're not going to the moon. We're not going to Mars. We're building roads people have built. We're building, you know, hospitals people have built. You know, so what we need to do is to have the humility to look across the world, what people have done, and then copy shamelessly from that, and then build what would build the Nigeria of our dreams, because that is what is going to make everybody, you know, happy and successful. And the last point I was just going to make is to say that, you know, local finance is very crucial. The debt capital market is very, very, very crucial to drive that, because like everybody said, what is sustainable is financing your infrastructure with local. Let's say, for example, roads. If we moved our roads to concrete roads, everything you need for the concrete road, it's made in Nigeria. So it's so crucial that, you know, if you expand the debt capital market, like what, you know, my friend Coco and his team are doing, like what China is doing, like what Thailand is doing, like what Malaysia is doing, we should be able to sort of take away the FS risk. Because once you're building in concrete, I mean, you know, there's a limited FX input. So that creates, you know, a currency, match in terms of what the revenues are and what there are a couple of other issues to do with the ecosystem, you know, which have to do with, I think some of the things are about regulation, but I think COVID is changing and has created a new normal for us. So I think that we can leapfrog those things, just like we have done with the telecom system, to build a Nigeria of our dreams. Thank you very much.
Thank you so much. I have no doubt that if we continued for another 20 minutes, you would have so much more to share with us. There are quite a few questions also coming your way if we have time. So, and just to make sure we have time, I want to encourage everybody to stick to that 3-minute timeline if at all possible. So let's move very quickly to Dr. Farouk Aminu. And Engineer Judy, you've already said it, we have an infrastructure emergency. And with around 11 trillion naira of pension funds to growing, this should really be a healthy source of domestic funding for infrastructure development in Nigeria. So, Dr. Aminu, in your view, what will it take to drive investment of pension funds in infrastructure securities in a meaningful way? What needs to happen?
Well, thank you very much, Dr. Abiola, and thanks to FMDQ and everybody. I believe the earlier speakers had really dotted all the I's and crossed all the T's in terms of what is needed. But the most important thing is that National Pension Commission is a regulator that has 2 key roles. One of the roles is social, and which is the primary, ensuring that the pension assets are safe and individuals who contribute to these assets receive their pensions as and when due. The second issue, which is primarily the issue that we're discussing today, is about investing the pension assets, which is our really secondary role, trying to enhance the primary role of making people have better pensions. So in terms of the development of infrastructure in the country, National Pension Commission has looked over the years from 2004 when we started the pension reforms to date, made a lot of changes into the portfolio of the pension funds. We introduced so many things and expanded so many limits that we put there for the various assets that are allowed on the portfolio. Then you see that under this arrangement, we allowed the pension funds to invest up to 20%. In some cases, actually 25% due to the introduction of the multiple fund structure. Fund 2 could go up to 20% in bonds and 5% in funds. So in total, we could have an average of 20% of the pension assets to be invested in infrastructure projects, 15% through bonds and 5% through funds. Now, what is eligible? Because not all assets are eligible, and that's why we're here. So there are a lot of regulatory requirements in terms of quality specifications. And when an asset class has met that quality specification, there is also a limitation as to how much could be invested in that particular asset class. Risk management is very important. People who are in this industry really would not take stories. Nigerian pension system has been painted black for quite a while, and the contributory pension scheme is still being viewed as the old pension scheme. And anything that would come that is going to tint this scheme black, no matter how little that black dot will be, we are trying as much as possible to avoid it. So we have these restrictions as to what a percentage of the pension assets could be invested in a particular issue and in a particular instrument, in a global limit. Now, having said this, National Pension Commission has been involved in a lot of initiatives of the federal government. For example, the infraco that has recently been approved by Mr. President for Central Bank to introduce. We have been made members of the implementation, largely because of what we could bring to the table in terms of investments by the PFAs. There are several similar projects that we are involved in, and I'm happy to see that some of the infrastructure securities that have been issued out The pension funds had invested really significant amount of money. Of course, when you compare with the total size of the pension industry, that is insignificant because we are yet to hit 70 billion naira out of a portfolio of a total of almost 11 trillion by close of June this year. So there is this thinking in the commission as to how do we make this asset work for economic development. What are the things that we need to target? Which areas of the economy shall we target? And indeed, there is no doubt, we have all agreed that we need to develop infrastructure and make intervention in housing. So these things, the issues that we are working, we have been talking to NMRC, the operators are already working on their own to come up with a product that is going to work in this aspect. Now we have been able over these years to develop an industry of 11 trillion naira. We could do much better. Nigeria is a huge country. The total number of retirement savings accounts that built these assets are just about 9.1 million. If you look at the working population in the country, we have about 100 million working population based from the EFINA survey of 2018. Out of this, only 8 million actually are working in the formal sector, both public and private. That means about 92 million Nigerians are, working population, about 92 million of the working population in the country are actually in the informal sector. And when you look at the informal sector database, the statistics we get is that we have about 67 million people. But when you look at the SMEDAN database, we have about 37 million registered SMEs. And 5 million of these 37 are already registered with the Corporate Affairs Commission. So what do we do? How do we take pension to them? Because contributions of those people is going to actually build the the pension pot bigger. So many things could be done. We've introduced the macro pension scheme in March last year, which was launched by Mr. President. The uptake is not very good still, it's still really very, very low uptake, but we know there are a lot of teething issues, some of them that we know have to do with some regulatory issues that we need to sort out to drive that market. If we could do that, given that we have over 60 million people in the informal sector, this is really going to be one of the remarkable future reforms in the pension system in the country if we could achieve this. The state governments, we just have about 12 states in the country that have made some reforms in their pension system. So we have 24 more to go. If we could have all the states to also come, we could say we will be able to cover all the 8 million working population, formal sector employees. So we target the SMEs. Actually, we have already started working with Central Bank in this regard, trying to say, well, looking at the intervention fund, the SME intervention fund by the Central Bank of Nigeria, if we have just one pension account from each of the 37 million SMEs, Central Bank make it a rule that for you to access the intervention fund, show us that you are responsible, that you have a pension account, even just the proprietors of these SMEs. If we could have this, then we could build the pension database from 9 million Nigerians to at least more than 40 million, because 9 plus the 37 million registered SMEs. So really we could do so much, but we believe that this is necessary in order to push the infrastructure financing efforts that the National Pension Commission is trying to advance. We have.
Dr. Aine, you've run out of time. If you could please just wrap up. Thank you.
Okay, just give me a minute, please. We have done a strategy. In that strategy, our focus is that one of the initiatives should be building investing up to 40% of the total pension assets in driving infrastructure financing. We have less than 1% at the moment. So really there is so much gap, and you could see that we have the initiative, we have the will to promote that. But one of the most important things is the financial health of the contributors. If you cannot actually solve your personal problems and then be able to divert some money to save for pension or for whatever reason, there is no way you can do it. So while we want to build this and that, we should also look at what opportunities government is providing to drive the financial health of the Nigerian people. It's really key, because that will help us a lot. The pension pot of 11 trillion has shown that Nigerians can really do it. Nigeria can do it. We built this just within 16 years of the pension reform. We don't know what it will be if we're able to actually increase the number of people who contribute into the pot. Thank you.
Dr. Amina, I'm not surprised that you couldn't keep to time. There's so much to cover there. But I think we may be able to come back to you during the Q&A. Clearly, investment of 70 billion out of a pocket of 11 trillion means that there's a long way to go. The 40% target is extremely encouraging, because we know from other jurisdictions that countries build their infrastructure through domestic savings. And this is a very important avenue for Nigeria in the future. So thank you for sharing that with us. At this point, I'd really love to hear from Mr. Aresh Aswani. It's my delight and real pleasure to turn to him. Over the past 2 decades of friendship, I have known Aresh as a true believer in Nigeria and an investor in game-changing businesses in Nigeria. Aresh, kindly share with us your experience of managing infrastructure projects, and in particular, the challenges you've encountered and some of the solutions that you've had to devise. Thank you.
Thank you, Gora. And also thank you, the eminent panelists who spoke before me. And I think you've covered many grounds for me in terms of risk assessment and financing of the infrastructure projects. What I'm about to share with you is what we went through to build an infrastructure project. And ours is a real life case. And as a group, we are now building the Lekki Port project. So I'll just share with you my blunt, real assessment. I know I'm going to step on some toes when I speak, but I think Gora knows me to be that kind of speaker. But I'll share with you the problems that we have in Nigeria and what we need to do, in my opinion, as me as a Nigerian too, to fix it, right? I can be holding a Singapore passport, but I'm still a Nigerian by heart. So it has taken us almost 10 years just from the conceptualization stage to taking it to where it is in terms of the project taking off. So if you can go to the next slide, right? I'll just share with you a few of the thoughts that I have, but I think I'll just share with you what I think is the biggest overall challenge that we have encountered was the lack of familiarity of the government organizations with the dynamics of the infrastructure project with a private sponsor. So what tends to happen is this. A lot of the infrastructure projects used to be done by government. When government does a project, contractors and financiers treat them differently. The execution is not done by the government. The execution is done by the contractors. Whereas when private people are engaged to do infrastructure project, the risk assessment by financiers and contractors are completely different. So we take on a very different role when we go in as a private investor. And because of the non-familiarity of government in dealing with projects on a private sector basis, we actually have to go stage by stage to every government body and educating some of the people that I must say shouldn't be sitting in that position, but we have to go through a process of time and patience of educating this. We have been fortunate because in our case now, when we dealt with ICRC, we had Engineer Chidi who really held our hand and understood what we need to do. But we had some previous cases where we couldn't do things and we had to wait for a long time to do this education process. So what I'm going to share with you are just 8 points very quickly. The first one is on the issue of value realization. If you can just change the next point, I'll just talk about what the value realization is. Adesi, could you help me change that, or do I change it from here? So I'm just putting what are our thoughts in terms of developing this infrastructure, right? So our point here is developing a private sector-led infrastructure portfolio in Nigeria that is focused on greenfield opportunities can take many years. And when I say that, means you have to come as private investors with deep pockets, and you have to be patient, and then you must have the perseverance and appetite to work over all the institutional organizations. We have worked with 4 change in governments. I have dealt with 6 MDs of NPAs. I have dealt with 6 Minister of Transport before getting the project off. Okay, so these are the risks that you all have to think of when you come and do projects in Nigeria. Can we move to the next slide, please, which is a perceived risk? So because of multitude of factors such as macroeconomic pointers, FX stability, ease of doing business, I must say this, while we talk a lot about ease of doing business in Nigeria, really, there is no ease of doing business in Nigeria, right? We really have to go around it to fix things ourselves. And this is an experience that I had. There are some great people who in NIPC, in the Vice President's office, who come and help you support it. But it's the people down the line who need to support infrastructure project. It cannot just be a few people. Everyone has to speak the same language. So if I go and speak to a Minister of Finance, Minister of Transport, Minister of National Development, any other minister that I need to speak to, they all don't speak the same language. So each one that I go to, I have to explain everything one by one, right? So these are the additional challenges that we have when we do a project. The next point I'm making is the development stage financing. An institutional ecosystem to support pre-development stage expenses of an infrastructure project might further boost private sector. So we actually had to use our own equity to do this, right? We didn't have a resource because many of the financial institutions didn't look at supporting greenfield projects because they didn't know what it's all about. So you actually had to raise your own capital first and use your capital to take it to where it is. And the next one is I'll talk about the participation of local investors, right? Can we move to the next slide, please?
Yes, one next slide.
No, I just spoke about this. Okay, so this is a slide that talks about participation by local funds and institutional investors together with international players might enable risk mitigation better by aligning with the interests of the local government. So in our case, in our project, what we structured very well, I think, and very nicely was we had the Lagos state government be part of it. We had the federal government be part of it because we got NPA to be part of it. And then we had private investors by inviting the Chinese to come in as an investor and our group as an investor. But I think there's an availability of more local investors to come in. So our aim now is to list this company in future, once we have developed and we have run this company in future. But I think local participation can come in earlier than later because you get the value of the participation at an earlier stage than later. So that's where I think people can promote more privately driven infrastructure projects and get more local participation on this. And the next thing I'm going to talk about is really just the project specific of what we went through, okay? And I'll share it as is, the way we went through it. And so I'm not holding anything back. So bear in mind that this is a real life situation for us, okay? So in the first part, for us to build this port, we had to obtain statutory permits. And just to give you all an example of the challenges we had, we needed a total of 38 permits from 15 different agencies were required for this port development. So there's no single window system that helped us get through this. In order for us to go through all these permits, it took us almost 3 years. It took us 3 years to go through this, right? So this can be actually shortened because the longer you take to do a project, the more money you spend, the cost goes up. So how do we then bring this down to a smaller level? So if you're coming to Singapore to build a port, you deal with only one agency. You deal with the Economic Development Board, and the Economic Development Board will give you all the permits within a timeline. So you don't have to be running around. But in Nigeria, we had to run to 15 different agencies in order to obtain all these permits. The second point I was going to make is about infrastructure support arrangement, right? Now, in our case, we had to deal with various stakeholders in getting all the infrastructure. And this was spoken by some of the other panelists earlier. For example, to make a port successful, you have to build roads. And the first thing we required was the road infrastructure that will allow us to move goods when the port is built to the cities that are required. Second thing is the possibility of building a rail line from various locations to this. In order for us to get financial closure, we had to get commitments from various state and federal agencies that they would build this road as soon as we build the port. Now, had this come in earlier, it would have made the financing much more easier. But we had to go through the whole process of this. And the other point I was going to make is, for us to obtain all the permits, we had to go through an FEC approval, we had to go through an FGN guarantee, ICRC ratification. And I must thank again Injijiri for helping us getting this ratification for ICRC. But all these approvals actually took 2 years. So the process of getting these approvals took so much time that the cost of doing a project in Nigeria escalates because of that. So in all of this, if we can all focus in Nigeria in terms of getting things done and getting it smoothly done. And I say it because I'm very optimistic about Nigeria. I want to ensure that people come and invest in Nigeria, but I'm one of them who has stomached the whole deal. But for future people to come in, we must make it easier for them. And how do we make it easier? I'm not going to talk about the last point, which is about USD and NGN FX stability, because I think Bolaji covered that at ground, and some of the other panelists also talked about what the risks are in terms of financing between local and foreign financing. So in a nutshell, that's what I'm going to speak about. I think my time is up too.
Thank you.
Thank you, everyone.
Absolutely. Well, thank you, Arash. I was very, very certain we would have a lot to chew on. The Q&A is blown up with questions from your presentation. We'll see what we can do to answer some of them. Let me just remind everybody also that we have a poll going on at the same time. Please do find a second or two to respond to the poll. It will be very helpful for us as we pull together the nuggets of wisdom from this session. We have a few more minutes, and there is a very important panelist that needs to still share with us his thoughts, Mr. Taiwo Adeniji. We've left the best for last. Mr. Adeniji is from the AFC, and as the presentation earlier was made very clear, infrastructure build-out gradually, generally, leaves a significant environmental and sustainability footprint. AFC has taken a leading role in sustainable financing in Africa. Would like to hear from Mr. Adeniji what the trends are that he's seeing in terms of the appetite for domestic and foreign sustainable capital for infrastructure development in Nigeria. Mr. Adeniji, please.
Thank you, Dr. Abiola, and good afternoon to the organizers and my fellow panelists. Yes, I'm talking, and a lot has been said about the importance of infrastructure in any economic development, especially a big country like Nigeria, and the different challenges that goes with financing and funding and developing infrastructure. One of such, of course, is the availability of capital. And in this case, the emphasis is on sustainable capital. And why sustainable capital? I would remember, say, maybe 20, 25 years ago, when we first started talking about environmentally and socially sustainable investments. At the time, these phrases or these works were almost like these works were more like little inconveniences that project developers need to go through in order to satisfy the international financiers, the international donors, and the MDBs. But I think today the debate has moved on from that. I think most developers, most project developers, particularly big infrastructure, do realize that ensuring environmental and social sustainability is actually part and parcel of the financial and economic viability of their investments. So it's no longer something that is being done to satisfy somebody else. It's more of what you need to do to ensure that your investment is actually on the long run economically viable. And where are the sources of this capital? Where are the sources? Generally, capital comes from the conventional banks, conventional institutions, the DFIs and MDBs, such as ours, AFC, such as my friend's Wallis institution, the African Development Bank. Then we also have the funds, the private equity funds, and in the funds group, I will also put institutions such as the Nigeria Social Investment Authority, as well as the pension funds. And obviously, we have the bond or the debt market, which we have had a lot about in the course of these discussions. Given the long-term nature of infrastructure financing, not much of it actually comes from the conventional banks. So most of this comes from the DFIs and MDBs and from the bond market. And what has been the trend? The trend has been significant amounts of sustainable capital or impact capital has been coming into Nigeria. I believe in the period between 2015 and 2019, we actually have close to $4.7 billion of this type of capital coming to the country. And this compares with, say, only about 1.8 billion that came in the 10 years prior to 2015. But as we have said, the volume of capital that is required to address our infrastructure challenges, these numbers are drops in the bucket or drops in the ocean. And therefore, we need to develop processes and strategies to match the requirements, the infrastructure requirements of a country such as Nigeria, to match it with the sources of liquidity that are available all over the world. And that's where I think both what my friend Bolaji has said and what Wale has said as well, there needs to be a nexus between the two. Ultimately, even for global institutional investors that want to invest in portfolio of assets, ultimately, we still have to get it to individual projects. Projects still needs to be developed. Projects still needs to be constructed. Projects still needs to be built and operated before they can actually form a sustainable portfolio. So what I will say is that we need to match the project development skills, project development expertise, and the project development capital of the DFIs and the MDBs, institutions such as the AFC, institutions such as the African Development Bank. We need to match those expertise with the huge pool of liquidity that exists within the global institutional investment community. And when we are able to do that, when we are able to match the source of need with the source of supply, then we will have a much better chance of achieving our objective of bringing sustainable capital into infrastructure development. And I will talk briefly about what AFC has been able to do and continues to do with respect to that. We have had quite a bit about project development capital. And since the establishment of AFC some 13, 14 years ago, project development has always been one of our key differentiators, because we understood from the get-go that developing infrastructure is not so much of lack of liquidity or even lack of capital. It's lack of sustainable and well-developed projects. And therefore, we actually have a self-standing and self-sustaining project development business that puts early stage capital, early equity into greenfield projects. And I had Mr. Aswani say that institutions don't want to do this, but AFC, we actually actively promote early stage equity into infrastructure projects. And the other important thing that we have done in terms of matching these two, the sources of need and the sources of supply, is the creation of platforms. That's one important part of our business. And what I mean by creation of platforms is that, for example, we put together our power assets, for example, in Nigeria, in other countries in Africa. We put these projects together and we put them in a platform. We put them in a power operating company. And this power operating company will be capable of being listed, and global investors will be able to invest in this kind of platforms. And through such investments, the operating company can develop more projects. We are doing it in power. We are doing it in ports, for example. AFC, we are developing a number of ports. We have done in Gabon, we have done in Mauritania, we are doing in Benin, we are doing in Côte d'Ivoire. And the objective is to put all of these ports together and create a ports platform, which we can then offer to global investors to invest in. And similar to roads, we are doing the same thing for roads as well. Thank you, Dr. Abiola.
I would love to hear more, but in the interest of time, I do need to be slightly undiplomatic. Thank you so much. You know, what struck me from what you were saying was the fact that there's a lot that AFDB, ADB, AFC, and other international organizations can do, but we must start by galvanizing private capital to start off this project, given the magnitude of infrastructure challenge that we have. And it's because of that I want to very quickly move into the Q&As, where we have at least 2 dozen questions waiting to be responded to. Let me assure you all that we won't be able to do that during this call, but we will document all these questions and go ahead and send them out afterwards. So let me take a couple, which we'll have time for, and then assure all of you that in due course you'll get answers to the rest of your questions. Let me also just remind everybody that the polls are still up. Kindly respond to them in the time that we have. So focusing on private capital, first and foremost, let me go first to Harish Aswani and really pose a question from the audience here. And they've asked that with all the challenges, all the difficulties, why did you bother with an investment in Nigeria? Why did you bother with an investment that would take 10 years to incubate? Harish, what's the answer? Is it just the love of Nigeria? Or is it extraordinary returns? What is it that keeps driving you to conclude what you started?
So the story behind this is this. We took then President Obasanjo to come to Singapore to pay a visit to our then Prime Minister, Mr. Lee Kuan Yew. And in that visit, Mr. Lee Kuan Yew told him, don't try and do too many things. Focus. If it's power, build power. If it's infrastructure, do infrastructure. If you want to do education, do education. And when we took him around to see the port services in Singapore, he came back and told us, I want you to build me a port exactly as what Singapore has built. So that's how we started our journey to build this port at the request of the then President Obasanjo. So it took us about 2 years to do a feasibility study to understand whether it was viable for us to actually build a port or not. And that feasibility made sense. And it actually showed that Nigeria doesn't need just one new port, but maybe a couple more in different locations of Nigeria. So if you look at the population of Nigeria of, as we say, 180 million people, we actually have only 2 ports running. One is in Apapa and one is in One. So our per capita consumption of containers coming into Nigeria is only 1.2 million containers a year for 180 million people. You have 600,000 coming to Benin next door for 3 million people. So that, I think, told us very clearly that there is a demand to build a port here.
There's an opportunity, and that opportunity is so great. That is really the story of Nigeria. We have the population, we have the commerce, we have the energy. It's now to build the infrastructure to support it. Thank you so much. Let me go to Mr. Balogun with the next question. And with long-term investments and finance for long-term infrastructure, the questions around FX risk really becomes very, very important. What are the challenges you see, and what are the solutions so that investors can be more confident with the investments over time?
So, you know, we're very much advocates of the thesis that infrastructure debt is primarily financed in local currency. And we don't come, you know, at that by theory. We come at it from very substantial empirical research. You know, all of the 46 nations that have succeeded successfully since the Second World War in financing infrastructure, primarily finance their infrastructure in their local currency. And it's the only way that you ensure that you don't bankrupt a country, because most of the infrastructure that you're financing, with the exception of ports, with the exception of airports, you know, basically have user receipts, you know, coming in the local currency. And every time that you face a currency devaluation, it is not possible to pass on those costs. And infrastructure sponsors, you know, business is not managing FX risk. That's what a bank and that's what financial markets do. And it's absolutely important that you pass on the risk to the right party, and you can focus on doing this. You know, one of my, first intersections, you know, with this fundamental issue came in January 2001, when we were applying for the mobile licenses in Nigeria. The NCC, or the regulator at the time, put out the instructions, you know, that, you know, we should be delivering dollars, you know, to the central bank for a license. And I happened to be leading one of the consortia at that time, the consortia that's now the mobile operator, Airtel Africa. And we approached the central bank and we challenged this issue. And we paid for our license, eventually in Naira. And I have to say to you that one of the reasons that all of the owners of that asset found themselves with a decent equity return at the end of the day, right, was this singular act. If we had borrowed dollars and done so, by the time we eventually sold the asset, even though we sold it, you know, for many times money, I think all of our returns would have been completely destroyed.
Thank you for that very powerful example. It really crystallizes FX risk if it's not properly managed. Let me move on to another question, and I think I'll turn to Engineer Chidi for this one. The question really says, do we have any policy or system or process through which idle assets across the country can be converted to economic assets? Oxford University is said to be doing something along this line in Ghana. And what impacts will it have in financing sustainable infrastructure projects? Engineer Chidi?
Yeah, we do have a national policy and various mechanisms for doing that. But I think that just like the point I made, what needs to happen is we need to turbocharge that process. We're not doing fast enough. We need to create a Formula One process to address both asset securitization. I use the word Formula One for a very, very delicate reason. Now, when you drive fast, people will advise you're likely to die. But the Formula One system is created an ecosystem where people can drive at breakneck speeds, do it safely, rules are understood, and do it profitably. So I think we need that sort of Formula One approach, to infrastructure. The second part I just wanted to do is I just wanted to build on part of what, if you allow me, on what Haresh had. So I think this is also to put things in perspective for us in our country. 32 permits, during construction, and these permits have to be renewed every year. It's completely unacceptable. Now, the other point is just at the time the project was reaching financial close, Lekki needed a letter written to China Development Bank, to reach financial close, and nobody agreed to write that letter. So one day I called Haresh and I said, look, what's happening? He said, no. I said, okay, I'll write the letter. And he said, what? I said, yes, I'll write the letter. The worst that can happen is that I'm killed, for attracting $700 million of investment into Nigeria. And I wrote the letter and I sent it to China Development Bank, and I'm still standing. Nothing has happened to me. And I shared to him the Jesuit law. It's easier to say sorry than to get approval. So I think what also needs to happen is that at our various areas where we are in our country, we need to be courageous. We need to, I'll give you an example. We're about to concession our airports. And I offered the certificate to the Minister of Aviation. The aviation labor unions have gone around trying to say it's the worst thing to happen. And Nigerians are not standing up to speak. We must stand up for our country. We must stand up for the good of our country. And just to give you a final thing, because I don't know I'm going to have a chance at it, we need a new governance structure for delivering infrastructure in Nigeria. At the top, we should have a presidential infrastructure coordinating council, like you have in South Africa, that says these are what our national priorities are, and then we move on it like that. And we, at the executive and legislature, we need to have an executive legislature infrastructure advisory council so that both the executive and the legislature agree this is what our national agenda is, and then we push it. And at the state level, we need those state infrastructure coordinating commissions that the state has what it needs to do. You need state infrastructure so that, and you need the same thing at the local government. So we are 36 states, but we're not 36 countries. Very often we behave like that because investors see one Nigeria. So I think we need to have that sort of coordination and that governance structure that identifies what Nigeria wants and we need to do. And we need courage to stand up for our country. Thank you very much.
Very passionate response. Thank you so much for just sharing those thoughts with us. We really are almost out of time. As I promised, a lot of the questions, in fact, all the questions will be properly dealt with, and we'll be able to share it with the audience at a later stage. I'd like to ask one question at this point, and I think it's a very important question for the audience. There's a question as to why the webinar is so much focused on Nigeria, and that there's a need for a more comprehensive approach for Africa. Let me pose that question first and foremost to our host, Mr. Bola Odelikoko.
I'm here, Dr. Abiola. This is about infrastructure development in Nigeria, and is how to leverage the debt capital market to develop that. So it's a Nigerian-focused situation. The challenges are about Nigeria, and we're looking to deliver Nigeria. Thank you.
Thank you so very much for that. I was wondering, as we wrap up this conversation and really see where next we go with this. A lot of great thoughts have come through. I was wondering if I could pass this on to Adeze so that she could then help us move very tidily to the end of the dialogue in the interest of time. Adeze?
Thank you, Dr.
Thank
Wura.
you so much.
Thank you, Dr. Wura. Thank you. That was a very insightful panel session, a lot of interesting perspectives, and lots of words of wisdom and nuggets on how to move the infrastructure space forward. I'd like to introduce our Group Chief Operating Officer for FMDQ, Ms. Kodi Ugoji, to wrap up this webinar with her closing remarks and the vote of thanks. Ms. Kodi Ugoji, please.
Thank you, Adeze. And good afternoon, distinguished ladies and gentlemen. It's really always exciting to have the caliber of people that we've had at this webinar today. It's just been 2 hours, but it's been packed with loads of value-adding thoughts. It's been very enriching. I'd like to start by thanking our panelists, our subject matter experts who have, again, shed a lot of light on what it is that we think we need to do to move the needle forward. It's interesting, again, for me, because all the panelists here are not just subject matter experts from afar, but they're also partners and collaborators with FMDQ. So it is always very exciting to hear from them, because we're in this together as we try to move the Nigerian debt capital market forward. I'd like to particularly thank Mr. Bolaji Balogun for the presentation. I saw in the comments lots of requests for that presentation. It was insightful. Thank you for that. And thank you to Mr. Southwell as well for also supporting on that presentation. Our ever able moderator, Dr. Abiola, thank you very much for steering that ship very swiftly and landing it and not losing out on the important points that were to be made. And to our panelists, Professor Elias, Mr. Shonibare, Mr. Mueller, Engineer Izuwa, Dr. Aminu, Mr. Aswani, Mr. Ade Niji, thank you very much for your contributions. Very well appreciated and very would be put to good use. Mr. Onodile had said in his opening remarks that the Secretariat will take down copious notes to ensure that everything that has been said today would be put to good use. We don't want to just keep talking. We want some action so that we can move forward. So I trust that our Secretariat would do a good job in distilling all that is necessary for us to move this forward. I'd like to thank our stakeholders, the 250 on here and I'm not sure how many on YouTube. Your support. I'm not sure we can even do this without you. We're not talking to ourselves here. We're working together with you to take the market to where it needs to be. I've read some of your comments, very insightful. Thank you very much. Even if some of them were not taken at this session, we will be taking note of some of what you've said, to take whatever we need to take out of it, and to take the value out of it. So thank you very much. We can't do this without you. FMDQ always says that collaboration is big for all of us. It's very big because you can't move forward by yourself. So we thank you for your support. Every time we call on you, you answer us. Thank you, and we will keep calling on you because I heard that the reward for good work is more work. So please rest assured that we'll come back to you for more of your expertise and to share more of your experiences with us. To the team that organized this, thank you and very well done. I dare say that this has been a successful event, and thank you and congratulations to everyone. Thank you again and have a great rest of the day.
Thank you so much.
Thank you very much for that. Very lovely welcome. Well, everyone, do have a good day. Thank you for your time today and have a lovely, lovely afternoon. Thank you.
Thank you very much.
Thank you. Bye-bye.
Bye.
Bye. Thank you very much.